What happens when the Fed chair hints at more rate cuts while stocks bounce off their lows? Will Powell's latest comments send the market soaring, or are investors still flying blind in this uncertain economic climate? CNBC breaks it all down. Don't blink, or you'll miss the next big move.
It just was, to me, the juxtaposition of Jay Powell with Cathie Wood was a little, did it strike you as a little bit odd or not?
You know, they put some interesting pairings here at NABE is all I'll say.
I guess it's like, maybe it's like us.
Exactly. But we did pick the right ties this morning.
Yeah, we did.
Joe,
Look at that.
Right, exactly. And the right color suit. Look at you with a suit on, by the way, and a wake afternoon, which is unusual, of course.
Right.
Fed Chair Powell suggesting, I think it's interesting to go through the nuance on this, though. He suggested but didn't explicitly say that rate cuts are likely to continue. He told the NABE meeting that the Fed's outlook for employment and inflation have not changed much since September, when Fed officials were forecasting another 2 rate cuts this year.
Rising downside risks to employment have shifted our assessment of the balance of risks. As a result, we judged it appropriate to take another step toward a more neutral policy stance at our September meeting. There is no risk-free path for policy as we navigate the tension between our employment and inflation goals.
Powell said the Fed was using a range of private sector and still available government reports to gauge how the economy is doing in the wake of the shutdown. That data so far suggests higher downside risks for employment and inflation, mostly from tariffs, not part of a broader inflation problem. He also noted that data prior to the shutdown showed the economy on a firmer path with those better growth. Now, this may be something that excited the market because separately, Powell said the Fed may approach a point in the coming months where it stops reducing the balance sheet, or QT. 3 points he made about that. One, there's some signs of liquidity conditions are tightening from firmer repo and other things that the Fed's monitoring. The portfolio is overweight longer assets, underweight shorter-term assets. And finally, the longer term, the portfolio should be primarily composed of Treasuries. Last thing is Powell's comments were not a decisive endorsement of those future cuts. He just said the situation hadn't changed since September, and he did not lean against, Joe, this is important, lean against the market expectations, which, as you know, are pretty firm for those 2 cuts this year.
How can anything change when you're not getting any government data?
It's a good question. It's why I didn't expect much change at all in his outlook. Had there been a bunch of reports, had they surprised to the upside or the downside, it might have changed his view. But basically, they're going on the trajectory they were on, Joe. It's a bit like you're in a car and all of a sudden you can't see anything, so you just kind of keep the wheel straight. Well, that wheel showed that you had the downside risk for employment increasing, and you had inflation was mostly from tariffs and not broader. But we'll see next Friday, Joe, when we have that CPI report come out.